Hey again. All right, we're going to jump into our second to last lecture, and this is all on the cash flow statement. So the book does not have a good chapter on the cash flow statement, and it's ironic because, and it's probably because the book is old, and I'll reiterate, I did not pick this book, but it's ironic that it doesn't because the cash flow statement now is what's used by many investors when they're looking at a company to determine if it makes sense to invest in a company, because ultimately the company's ability to bring in cash and not overspend their cash or spend their cash effectively to grow the business is the best indication of a company's future. And we spend a lot of time as accountants talking about the balance sheet and the financial statements. I mean, in the income statement, and there's good reason for that. But as an investor, if you want to know how a company's doing, you focus on that cash flow statement, and you'll have the best indication of how the company's doing and how you can predict them to perform in the future. The reason accountants spend the majority of their time on balance sheets and income statements, and I'll tell you, in my line of business, as an accounting manager for a manufacturing company, a large manufacturing company, and I'm the accounting manager for 3 North America sites, I don't do anything related to a cash flow statement per se. I get lots of questions based on what we call working capital, which is a large piece of the cash flow statement, and it drives our ability to bring in cash and to spend our cash effectively. But I don't prepare a cash flow statement. I don't really even look at a cash flow statement unless I'm looking at Thermo Fisher's financial statements online. As an auditor, I spend a lot of time on the cash flow statement, again, because if you are opining on financial statements, you have to make sure that cash flow statement's right, because it's so heavily relied on by investors. So so what I'm going to focus on here is just giving you guys an understanding of the cash flow statement, and I'll talk about a few topics, but then I will I'll open up an Excel file and we'll look at it together. I think that Excel file is already on Moodle, and it'll be just a good way for you guys to maybe understand the cash flow statement a little bit better. So and the other point that I wanted to make, the reason we spend a lot of time on the balance sheet and the income statement as accountants is because everything that's in the balance sheet and the income statement, that's where you record your transactions. There's the debits and credits, or either the balance sheet or the income statement. That all feeds the cash flow statement. So you have to have all of that right. You got to do all of that first so you can get your cash flow statement, which is critical to investors. Okay, so there's 2 different ways you can perform a cash flow statement. You have your direct method and your indirect method. I'm not even going to spend any time on the direct method, and the reason for that is outside of me being an accounting student, that's the only time I ever learned the direct method. The indirect method is what is used, what is preferred. I did a quick Google search. I did a similar presentation to my colleagues to give them some basics on the cash flow statement, and I couldn't find any companies that did one that it was published. So the indirect statement is just a way to present the cash flow statement. It's how you're going to see it in most all companies that you ever look at for a cash flow statement. Basically, what it does is it starts with net income, which is directly from the income statement. And it takes non-cash transactions, so transactions that have been recorded on the balance sheet or the income statement that did not have cash, and it adjusts for that to ultimately get you to your net cash amount. And then within the cash flow statement, there's 3 sections. You've got your operations. That's kind of telling you how you're running the business. You have your investing. That's telling you how you're taking your money and investing it back into the business. And then finally, your financing. And we just talked about financing in relations to liabilities and equity. So what that tends to focus on is your equity type financing, as well as some long-term financing. So not your accounts payable and short-term financing items, but the equity in the longer term ones. So your operating, the operating section of the cash flow statement is going to talk about, I've already alluded to this. This is kind of where the working capital accounts are. And we'll talk more about some working capital accounts when we talk about financial statement analysis. But your working capital accounts tend to be your current assets and your current liabilities. So think of those as your accounts receivable, your cash, your inventory, your accounts payable, those short-term accrued liabilities like accrued payroll. And remember, because they're current, that they're going to be turning into cash or being paid with cash within less than 12 months or normal operating cycle. Okay. So investing, again, that's going to be your longer term items. So this is going to be if you go and buy some fixed assets, okay, so not a current asset, right? So you go and buy machinery and equipment that's going to have a 10-year life. You go and purchase some buildings, autos, automobiles. It's going to be some longer term debt, but not financing debt. So maybe you bought a car and you have a 3-year payment plan on that car. That would fall into, it's not short term because it's longer than a year, but it's not necessarily financing the business like you would be if you needed to go get $1 million influx of cash from a bank. Just slightly difference there. I tend to think of when we start trying to separate investing and financing, I always remember anything like any large asset purchase would go into investing. But then when you're trying to think of, is it long-term debt, is that investing, or is it financing? Did you take out that long-term debt to buy an investing activity like a car? Or did you take out that debt because you needed to insert some cash into your business? Okay, you needed to finance some operations in your business. It's a little gray, but not really. But for the purposes of this class, it's a little bit more ambiguous for sure. So there's a couple very simple rules to remember, and we'll see this when we look at the example here shortly, is if you have an asset that increases, okay, let's talk about inventory. So in one period, you have $100 of inventory, and in the next period, you have $200 in inventory. Then the asset has increased, so it's gone from 100 to 200. That means that you've spent cash, and cash has left the building because you had to spend $100 to get $100 more of inventory. So an increase in cash is going to be an increase in inventory or a current asset is going to be a decrease in cash. Okay. If you have a decrease in assets, and I like to think about this in the terms of accounts receivable. So you started the period or the year with $500 that were owed to you from customers, and you ended the period with only $100 that was owed to you from customers. In that situation, you received $400 in cash from your customers. So your assets went down, but your cash went up. They have the inverse relationship, okay? So if assets go up, then your cash is going down. If assets go down, then your cash is going up. Okay, it's the opposite with liabilities, all right? If your liabilities increase, then you can think that your cash that you brought in has increased, okay? If your liabilities have decreased, then that means you had $100 that you owed to a vendor. Now you have $50 that you owe to a vendor. It's your liabilities, they went down. That means you had to pay that one vendor $50. So $50 went out the door. Okay? Liabilities go down, your cash goes down. Okay? And then equity. If your equity increases, that means you had more financing activities from your owners. They've given you more money, then that means your cash has gone up. If your equity decreases, which probably means you've paid your owners some money because they were owed it, then that means your cash is going down. Okay? Just really basic rules. Assets go up, cash goes down. Liabilities go up, cash goes up. Equity goes up, cash goes up. Okay? If you think about it, the opposite's happening on either side of that equation. Remember, assets equals liabilities plus equity. So the inverse relationship's happening on the other side of that equation. Okay. All right, let me show you our little cash flow example. Share. Okay. I think you can see this. I hope you can. All right. So we're just going to talk about some basic balance sheet accounts that we've already talked about in relation to these assets and liability accounts. And we're going to talk about it. We have to, oh, if the cash goes up. Okay, sorry. I made a typo on that. All right. So you have to look at it within 2 periods because the cash flow is the change in cash. So from the beginning of the period to the end of the period, right? And then we're going to create a very basic cash flow statement over here on the side. All right. So let's start here. So the end of period 1, our cash was $20,000. And the end of period 2, it's $35,000. So it means our cash has gone up. Okay. So the effect on cash is an increase in cash. It's the cash one. Okay. So we've got our accounts receivable. It's a current asset. End of the period, it was 30,000. In the end of the next period, it was 40. So our assets have gone up. What's the effect on cash? Cash has gone down. Okay. Cash has gone out. Inventory, one period it's 50,000, goes up to 60,000. The net change is increased $10,000. Our inventory balance did. Our current asset increased 10,000. So what's the effect on cash? Decrease. All right. Same concept. It doesn't matter if it's a current asset or a long-term asset. The relationship with cash is the same. That just helps you identify where it goes on the cash flow statement later. Okay. We had at the end of period 1, we had $100,000 in equipment. The end of period 2, we had $120,000 in equipment. So that's an increase in an asset. Therefore, we bought more equipment. That means cash has gone out the door. Decrease in cash. And then in this example, we have an asset of buildings. It's the same amount at the end of each period. So there's no change, no effect on cash. All right, so now let's talk about liabilities. Accounts payable, end of one period is 50,000. End of the next period is 55,000. That means our liabilities have gone up. So what is that? The effect on cash? That means it's gone up $5,000. Our accrued liabilities, they're current. They've stayed flat year over year. No change, no effect on cash. Got a long-term liability of a bank loan. At the end of period 1, it was 100,000. End of period 2, it was 120. So our liabilities have gone up. Therefore, our cash has gone up. Okay. Then our equity is paid in capital in this scenario, and there's been no change. So there's no effect on the on the cash flow statement, excuse me. All right, so now let's build our indirect cash flow statement using these facts. As I mentioned, the indirect cash flow statement starts with net income. That's the beginning point. And then we take our balance sheet items and adjust the net income for the changes in those. And then we also, which I didn't mention before, but if there's a non-cash transaction in our net income statement, most everything is cash transactions in our income statement. But if there's a non-cash transaction, and in this scenario and in most scenarios, that includes depreciation, you have to remove that from net income so you can get what your true cash transactions are, okay? So depreciation is an expense and it reduces your net income by $5,000. So to take it out of net income, and you have to add it back, okay? So we're gonna start with net income, and then we're gonna add back our $5,000 in depreciation. And then we know that our current asset items there are operating account items, our working capital items. They're gonna flow through our operating section of the cash flow statement. Therefore, we've already accounted for the change in the account balances and their effect on the cash flow statement over here. Highlight these for you. So we start with net income. We add back our depreciation because it's a non-cash transaction, excuse me. And our accounts receivable has gone up 10,000 and our inventory has gone up 10,000. That means it's reducing our cash because of our effect on cash by 10,000 each. So we subtract those two. And then we come down here, also operating is our current liability amounts. And if accrued liabilities change, it would go up here as well, but our only change is our accounts payable. It's gone up $5,000. So that gives us, if you add all of these together, 25 plus 5 minus 10 plus 5, we've increased our cash by $15,000 for this period from our operations. So we've had an increase or an inflow of cash from operations of $15,000. All right. So then we're going to talk about our investing activities. So this is where you have to really understand what goes into investing versus what goes into financing. And in our example here, we have 2 items left that we would need to include. And as we mentioned earlier, changes in long-term assets, such as fixed assets or buildings, would all flow through investing. Like this. Let's see the colors. So in this case, excuse me, our fixed assets are changing. They're increasing by 20,000. We didn't have any change in buildings, so it's just our equipment. That increase in the asset decreases our cash. Therefore, our cash flow from investing activities is just a negative $20,000. Or that means we've spent $20,000 of cash flow from investing activities, okay? So then our last 2 items here, we talked about, changes in equity and changes in financing activities, such as like a long-term bank loan is going to go into your financing activities here. Okay. So here our capital has stayed the same. Our bank loans have increased by $20,000. Therefore, our financing, cash flow from financing has increased by $20,000. All right. So to finish off your cash flow statement, you have to have a reconciliation to cash. So you say your change in cash, which is going to equal the increase in $15,000 from cash flow from operations, your decrease in investing by $20,000, and your increase in financing by $20,000, or your change in cash is $15,000. Then you take what you had at the beginning of the period, which was the end of period 1. So you take your increase of 15,000 plus your 20,000, and that should equal your end of period cash balance at the end of period 2. And it's just that simple. So seems like a lot. The cash flow statement is a complex statement to be able to perform it. I'm never going to ask you in this class to recreate a cash flow statement. I want you to understand conceptually what is happening with what is happening in a cash flow statement, and why and why each of these different movements are important to investors and how you read it. So this means that the company in their daily operations, they have a positive cash flow amount, okay, of $15,000. So that's a good indication that they're running their business well, they're not overspending, they're not buying too much inventory and not able to pay it. That's a good indication they've got positive cash flow from their operations. The investing and the financing is how they may be taking the cash flow from the operations and reinserting it into the business or paying off old debt. Okay. So this is just a good indication of how a company is being run and how well they'll perform in the future. You know, if everything was negative for multiple years or multiple periods, you need to start getting worried about the ability of that company to be able to survive, right? If your operations, the cash flow from operations continues to be negative and you have to keep getting money from your owners to keep the business afloat, it's probably not a good company to bet on. Now, in certain cases, early years of companies, that may make sense because you got to spend a lot of money to build customer base, et cetera, et cetera. But if you're talking about a Starbucks, for instance, if their operating cash flow is negative year after year after year, then you have a problem. And that's probably not a good company to invest in. So just kind of keep that in mind. I went through this fast. I think if you take this this video and you pair it up with the slides, that will help understand a little better. But please ask me questions. I do want you guys to understand the basics of the cash flow. I'm not going to ask you to recreate one, but I do want you to understand kind of the movement of cash and how it's reported and why it's important. So I hope you all have a great week.